Today, we will talk about the Great Depression, overview, causes, and effects. The term Great Depression refers to the greatest and longest economic recession in modern world history, which ran between 1929 and 1941. This period was marked by economic contractions, including the stock market crash of 1929, and it is often cited as one of the largest catastrophic economic events of the 20th century. The stock market crash of 1929 was caused by speculative frenzies and the inflating of the stock market and real estate bubbles. Loose money supply and high levels of margin trading helped fuel an unprecedented increase in asset prices, ultimately leading to the crash. The stock market crash wiped out nominal wealth, sending the U.S. economy into a tailspin, with the unemployment rate soaring to over 25%. Despite interventions and government spending, the economy remained in a depressed state for years. The Federal Reserve's mismanagement of the money supply and credit, the rapid expansion that preceded the collapse, and the subsequent severe reduction of the money supply all contributed to the Great Depression. The Fed failed to take necessary measures to prop up the U.S. financial system and instead watched the money supply collapse and let thousands of banks fail, leading to deflation and spurring on the Depression further. President Hoover took action to keep prices high and wages high following the crash, but these efforts were not sustainable and further worsened the economic situation. Hoover's legislation to prop up prices and wages by choking out foreign competition, as well as the retaliatory tariffs imposed by other countries, further worsened international economic conditions. President Roosevelt's New Deal, aimed at reducing unemployment and protecting the public, involved a series of domestic programs and acts, but its success in pulling America out of the Great Depression is still debated by historians and economists. Although the war didn't end the Depression, it put the United States on the road to recovery and opened up international trading channels, reversing price and wage controls. The Great Depression was caused by a combination of factors, including the stock market crash of 1929, the gold standard, a drop in lending and tariffs, banking panics, and contracted monetary policies by the Fed. The Great Depression started following the stock market crash of 1929, which sent the U.S. economy into a tailspin and eventually affected Europe. The Great Depression ended in 1941, around the time the United States entered World War II, leading to a drop in unemployment and an increase in GDP. The Great Depression was the result of an unlucky combination of factors, and while many reforms from the New Deal still exist today, the legacy of the Great Depression is one of the reasons the federal government now acts in times of national economic crisis. Here are 5 key takeaways. 1. The Great Depression was the greatest and longest economic recession in modern world history that ran between 1929 and 1941. 2. Investing in the speculative market in the 1920s led to the stock market crash in 1929, which wiped out a great deal of nominal wealth. 3. Most historians and economists agree that the stock market crash of 1929 wasn't the only cause of the Great Depression. 4. Other factors including inactivity followed by overaction by the Fed also contributed to the Great Depression. 5. Both Presidents Hoover and Roosevelt tried to mitigate the impact of the Depression through government policies. Hope this would help. Thanks for watching.